Bill, thank you very much for joining us in the studio.
Good to be here.
How are you feeling?
Very well.
Good. So the buyback, $1 billion, and then you're planning about $5 billion over about 3 years. That is roughly in line with what you've been doing over the last few years. Are you lacking ambition on the buyback and the return of cash to shareholders?
I don't think so. We set out the target 2 years ago of returning in excess of $5 billion over 3 years. We've done 5.5 in 2.
Okay.
So I'd say we far exceeded the initial expectations. Why are we able to buy back that stock? Because we're doing really well in our business. Right? We generate profits. We're investing healthily in the business, so we're definitely investing for growth. We've got great top-line growth in our business. We're forecasting continued good, strong top-line growth for the next 3 years. We've got good control of expenses. We've had very low loan impairments. You know what that means? That means we generate equity, which we can invest in the business and then give a chunk back to shareholders. So we've extended our guidance to say, beyond the 5 that we said 2 years ago, we're going to do 5 from here. And that's.
It sounds like you want to be topping that 5. It's the target, but you hope to top it.
If we can outperform the relatively strong guidance that we've given to the market, which we've done in the past, then of course there's more to go.
Okay.
But we'll also be looking for ways to continue to drive that growth.
Okay. And you talk about costs, you talk about efficiency, you've got the Fit for Growth plan.
Yep.
Give us a little bit more granular detail in terms of what that actually means. What are those efficiencies? Where are you finding them? What does it mean for the structure of the bank?
Yeah. The other thing that we said 2 years ago was over 3 years we'll take out $1.3 billion of gross expenses. Now we said we're going to take another $1.5 billion out over the next 3 years. But we're going to do that by accelerating the transformation of our bank. So that means significant investment in that, we'll call it, you're never done with technology investments, but the last phase of the technical transformation of our bank, building on years of foundation laying, some excellent interfaces with clients, both corporate and individual, excellent investments in digital banks. Now we're going to complete the task and get end-to-end processes that are completely aligned, but also look across those processes. So call it shared service centers or centers of excellence that they can leverage the excellence that we have in verticals horizontally to get another $1.5 billion of expenses out while transforming the bank, making it easier to get things done, a better experience for customers.
That transformation, look, we've reported, Bloomberg's reported on the discussions around a potential restructuring, so potentially moving out the investment bank from the commercial and corporate part of the business and that unit. Is that still part of the discussion? Is that still part of the thinking?
I don't know what the investment bank is. I mean, we just have a corporate bank. We call it the CCIB business.
Yeah.
But in that, we've got a really nice trading business, which does very well.
Yeah.
Very flow-oriented. So it's all about the ongoing day-to-day activities with customers. We've got a fantastic transaction banking business, cash management, trade finance. Of course, we have a lending business. The fastest-growing part of that is sustainable finance. So it's an integrated whole.
So you're not carving it out. You're not carving out the investment bank from this.
There's nothing to carve out. I mean, it's half our bank, a little bit over half our bank.
You're pushing back on the restructuring story.
Well, I don't know what the restructuring story is. Look, from our approach, so we've got a Fit for Growth plan, which is fundamentally about transforming the way that we get things done in the bank. We will always adjust the organization to the strategy. We don't do it the other way around. We don't do organization, now let's find a strategy that works for that. So, of course, I'll be looking, have always looked, and we've tweaked the organization continuously. We'll look for opportunities to align our organization ever more to that strategy, including the Fit for Growth piece of that.
Okay.
So, yeah, I mean, constant change. That's what
you met the return on tangible equity targets, 10% for this year. You're looking at 12% in the next couple of years. Some investors will say, look, we still need that ambition. Price to book, you're trading at 0.4%. The stock is down about 40%. It's up in the session today. It was down about 40% since 2015. That there needs to be a more comprehensive plan to extract value from this business.
Yeah, I mean, it is down. We're not happy with the share price at all. And I think we ask ourselves the question all the time, why? Well, why does the market not recognize what we see in terms of the value of this business? And I think part of that is that there is a sense that it's hard to get things done in Standard Chartered. And this Fit for Growth program is going to tackle that head on. There's a sense that our cost base is high relative to our income. Now, obviously, there's two ways to deal with that. One is to get the income up, which we've done quite successfully. We'll continue to do that. And the other is to make sure that the cost grows slower. So we've guided to positive jaws. So income growth faster than cost growth in each of the next 3 years. That's a key component of our strategy. Of course, we're going to maintain the discipline that's had us generating credit losses and impairments that are much lower than our historical average and lower than our peers, which also gives us capacity to invest now in that business. So
what does it mean for jobs then? Are we going to see the likely kind of headcount cuts that we've seen across some of the other major banks? Is that potentially what is in the cards?
You're going to see a transformation of the bank and the way that we do business. And of course,
talk to us about numbers. What about jobs?
No. We'll talk about roles. So there are roles that will disappear. There are clerical jobs or administrative jobs or all that manual stuff.
Hundreds, thousands?
No. Well, but let's get a few numbers on the table.
Yeah.
Our typical attrition in a typical year is between 10 and 13,000 people per year. That's voluntary attrition. People come, they go. We've got 30,000 people in India. People cycle through Kuala Lumpur, Tianjin, Guangzhou, etc. So that's most of what we would have in terms of transformation, we can handle through natural attrition. The important thing is when we look at transforming that business, we know that there are going to be roles that go away as they're automated. We know that a year, 2 years, 3 years ahead of time. So we start training our people early on. We've got a massive program for reskilling and retraining. And our objective is to have every single person in our bank have a chance to remain in the bank even if their role goes away.
What are you thinking when it comes to China? The focus on the real estate market. You've talked about, you think maybe we've hit the bottom in terms of the pressure coming through for the Chinese real estate market. Is that, do you stick to that line?
No,
what keeps you relatively confident?
Yeah, I've not called the bottom, just to be clear. I think we've seen now several quarters of stability, but that's with a consistent level of stimulus that has just kept it from falling. So, look, we've got 88% coverage on our at-risk Chinese commercial real estate portfolio, right? So, I mean, we've written it off. I hope we get some recoveries one day, but I think it's going to be a long recovery, just as a practical matter. We were way ahead of the market in taking those provisions, as we were way ahead of the market in taking other provisions related to other businesses that have been impaired. We also set the target 2 years ago of doubling our profits in China over 3 years. We've almost done it in 2, doubling the profits. Now, the juxtaposition of China's having a tough time with we doubled our profits, that's a pretty good outcome. And it's a good outcome because we're generating good, strong top-line growth because we connect China to the world and the world to China. That's what we do, and those connections are stronger than ever.
Are there major impairments coming through from the China exposure for Standard Chartered?
No. We took virtually no exposure, no impairments on our China real estate in the fourth quarter. We did in earlier quarters. We've also taken impairments in earlier quarters on our stake in Bohai Bank, which we took a relatively small impairment in the fourth quarter. This is a kind of a mechanical calculation, value in use. We're properly provided. Commercial
real estate, of course, in focus as well in the West, in Europe, in the US. Do you see opportunities there, given the valuation drops?
Yeah, there could be. I mean, we're not going to be heroes in the commercial real estate market, but we're relatively underweight commercial real estate. We're relatively underweight leveraged finance, 2 areas that have been hit quite hard on the back of higher interest rates. Will there be opportunities for us to improve the quality of our franchise using our balance sheet in a prudent way, getting some of that asset growth that actually has been a bit elusive for us, getting that back in through some of the areas where our prudence has kept us out of harm's way? That's why we have such low loan impairments. Yeah, there's great opportunity.
It's starting to look attractive to you now. Commercial real estate.
Look, I'm not calling the bottom of any of that. I've also been in the higher for longer rate category, right? And I'm no pundit when it comes to interest rates, but it has felt to me that the U.S. job market is particularly strong. Wage growth is strong. That means higher for longer, and obviously that's what the market is saying now.
Is Standard Chartered going to be involved in consolidation? Abu Dhabi First Bank, they looked at you. Are you looking at consolidation? Are you looking at any changes in terms of assets across the business? Are you looking at any potential tie-ups, partnerships? How are you thinking about that question?
No, we've made a few big investments in recent years. We've created 9 digital banks, two quite prominent ones in Hong Kong and Singapore. We've opened a new bank in Saudi Arabia 3 years ago. We opened a new bank in Egypt 3 weeks ago. So we've got a good, strong investment program. Frankly, those investments at book value.
So this is organic growth?
All organic growth.
And that continues?
Those are much more attractive to me than going and paying a premium for somebody else's business that you don't know so well. We've also exited quite a bit. We announced the exit of 7 onshore African markets. So
the aviation
retail
business?
We sold our aviation business.
Are there more disposals along those lines?
Nothing that we're working on right now. Certainly nothing that we can talk about. Nothing material. But the point is we've got a criteria for everything that we do.
Yeah.
And if we hit the criteria and we like it, we buy. If we miss the criteria, we don't like it, we sell. Very happy to do that. We'll continue to do that.
Bill, you're one of the longest-serving executive CEOs.
Ancient.
CEOs, well, I wouldn't go that far. Longest-serving CEOs, one of the longest-serving CEOs of a major UK-listed bank. 9 years into it, you're almost a decade into it. What's next for Bill Winters? And what do you want your legacy to be when you step away from Standard Chartered?
For a long time, in my time as Standard Chartered, we said we really want to get to double-digit return on tangible equity. When we set that objective initially, that was our cost of capital. Looking at the market, it's no longer our cost of capital. The cost of capital is higher. And we've said we want to get to 12% by 2026. I think that's a very achievable target. I would love to deliver 12% plus in 2026, and I'd like to deliver the 12% where people say, yeah, it's 12% now, but we can see it going 13, 14, 15 in subsequent years because this franchise is humming. That's the legacy I'd like to leave.